nearly 24 Bitcoin a minute. That is the pace at which roughly 594 BTC left a set of wallets in a sweep that reporting puts at around 25 minutes from first transaction to last. At this morning's price of about $64,000 a coin, that works out at close to $38 million US, gone in less time than most people spend commuting to work. CoinDesk published the story in the small hours of Friday the 31st of July, 2026, and Global Crypto followed within roughly 20 minutes, both pointing to a suspected flaw in Coldcard hardware wallets as the line of inquiry. That detail is exactly why this has landed so hard. This was not an exchange collapse, and it was not a crude phishing email aimed at beginners. The coins appear to have been sitting in cold storage, the arrangement the Bitcoin community has spent well over a decade recommending as the gold standard. The investigation is live, and no confirmed root cause has been published. Focus on the clock rather than the total. 25 minutes is not the signature of somebody typing transactions by hand. It is the signature of a script that already had everything it needed, running through addresses in sequence until the balances were empty. In practice, that means the private keys, or the seed phrase that generates them, were in the attacker's possession before the first transaction was ever broadcast. The sweep itself was just the withdrawal stage of something that had already gone wrong. That is an important distinction, because it separates two very different failure modes. One is a device that signs something it should not sign. The other is a device, or a process around it, that leaked its secret material at some earlier point, perhaps weeks or months earlier. Until researchers publish reproducible detail, both remain on the table. Anyone telling you confidently which one it was this morning is guessing ahead of the evidence. To understand why this stings, you need to know what a device like a Coldcard actually does. Coldcards are made by the Canadian firm Coinkite and are built around air-gapped operation, meaning the device never needs to touch a computer or the internet at all. You prepare an unsigned transaction on your laptop, save it as a partially signed Bitcoin transaction file onto a microSD card, carry that card physically across to the signing device, approve the details on its own screen, then carry the signed file back. The private keys never leave the hardware. That physical gap is the entire security model, and it is why serious holders, businesses, and treasuries adopted these devices. Compare that with a hot wallet on a phone, which is permanently connected and therefore permanently reachable. If a flaw can defeat an air gap, it undermines the assumption that keeping keys offline is sufficient on its own. That is the real story here. The practical effect this morning is a wave of anxious checking. Anybody running an air-gapped signing device is refreshing their balance, digging out backup sheets and asking whether their firmware is current. Hardware wallet holders are not a fringe group. Self-custody grew sharply after the exchange failures of 2022, and a large share of long-term Bitcoin sits on exactly this kind of device precisely because owners did not want counterparty risk. There is also a hard lesson in the numbers. 594 BTC concentrated in one sweep suggests significant holdings clustered under a single seed or a related set, which is the opposite of the diversification most security professionals advise. Spreading coins across separate seeds, separate devices, and multi-signature arrangements does not prevent a flaw, but it caps the blast radius. This morning, that principle has just been demonstrated in the most expensive way possible, and it applies whether you hold 594 Bitcoin or half of one. Here's what may surprise you. Bitcoin is trading around $64,000 this morning and the theft has not produced a visible dent. A $38 million loss is devastating for whoever suffered it, but against daily spot volumes measured in billions it is simply too small to move price. Markets differentiate between a protocol failure and an individual security failure, and nothing about this incident touches the Bitcoin network itself. The blockchain performed exactly as designed, which is unfortunately the point. Bitcoin transactions are final and irreversible. Context matters too. Overnight, South Korea's Kospi index posted a record surge of about 17% and crypto was left essentially untouched by that move. So we have a session where equities delivered a historic rally, a major theft made global headlines, and Bitcoin sat quietly near $64,000. That decoupling tells you the current market is being driven by flows and positioning rather than news reaction. So what should you actually do on Friday the 31st of July, 2026? First, do not panic move funds. Rushed transfers under stress are how people send coins to the wrong address or expose a seed phrase to a connected computer. Second, verify your firmware version against the manufacturer's official website, typed in by hand rather than reached through a search advert or a message. Third, treat any message claiming to be urgent security support as hostile. Every high-profile incident is followed within hours by impersonators offering to help you migrate to a safe wallet, which is simply theft with better manners. Fourth, confirm your backup is where you believe it is and that it has never been photographed, typed into a phone or stored in cloud notes. Fifth, if you hold a meaningful amount under one seed, start planning a split into multiple seeds or a multi-signature setup once the technical facts are confirmed. Expect the picture to sharpen quickly over the next few days. On-chain analysts are already tracing the destination addresses, and because Bitcoin's ledger is public, those coins can be watched indefinitely as they move towards mixers, bridges, or exchanges. Exchanges typically flag and freeze deposits linked to a high-profile theft, which is why stolen coins of this size often sit dormant for long stretches. On the technical side, the sequence usually runs like this: independent researchers attempt to reproduce the issue, the manufacturer publishes an advisory, and a firmware update follows with disclosure details. If a genuine device-level vulnerability is confirmed, the fallout extends well beyond one brand, because it will prompt fresh audits across the entire hardware wallet sector. If the cause turns out to be a compromised backup or a counterfeit device instead, the lesson shifts from engineering to process. Either outcome will reshape how people talk about cold storage. Here is the line to carry away. Cold storage is not a promise, it is a reduction of risk, and it only works when the whole chain around it holds, including the device, the firmware, the backup, and the human being. 594 Bitcoin left in 25 minutes because whoever took them already held the keys, and no amount of offline hardware protects a secret that has escaped. Concentration is the multiplier that turned a security failure into a $38 million one. Split your holdings, verify your firmware from official sources only, keep backups off every connected device, and treat urgent help offers as attacks. Bitcoin at $64,000 this morning is a reminder that the network is fine, but your setup is your own responsibility. Watch for the official advisory in the coming days, act on confirmed facts rather than headlines, and review your own arrangement before you need to.